It happened quietly, no headlines, no warning. While you were working, paying bills, trying to save, a law was passed that changed everything you thought you knew about money. A law that turned your bank account into something that doesn't really belong to you anymore. This is the story of how governments and banks found a way to make you pay for their mistakes legally. It's called a bail-in. And if you think it can't happen where you live, think again. Let's start with what most people still don't understand. When you deposit your money into a bank, that money no longer technically belongs to you. It becomes the bank's property. What you own is a claim, a promise from the bank to give it back on demand. But if that bank fails, that promise can vanish overnight. For decades, we were told not to worry. Governments had a safety net, the bailout. When banks took too many risks and collapsed like in 2008, governments stepped in, printed money, and saved them. Trillions of dollars. It was sold as stability, but it wasn't stability. It was theft in slow motion, inflation stealing from every worker, every saver, every retiree. The public outrage was enormous. Never again, they promised. But politicians and bankers didn't fix the problem. They just rewrote the rules. In 2010, during a quiet meeting in Basel, Switzerland, and later in Brussels, London, and Washington, the world's financial regulators drafted a new global framework. Bail-in policies. Under a bail-in, when a bank fails, it's not the government that saves it. It's you. Your savings, your deposits, your pension funds can be legally converted into bank equity to recapitalize the system. In simple terms, your money becomes their solution. They even published it publicly. In 2011, the Financial Stability Board, under the Bank for International Settlements, declared that shareholders, bondholders, and depositors will bear losses. Depositors. That means you. You see, a bailout uses taxpayer money to save the banks. A bail-in uses depositor money, the people already inside the system. It's faster, quieter, cleaner. And when it happens, there's nothing you can do. The first real test came in Cyprus, 2013. People woke up one morning, went to their ATMs, and their accounts were frozen. Within hours, every deposit over 100,000 euros was slashed by up to 47%. The money wasn't stolen by hackers or criminals. It was seized legally to stabilize the financial system. Politicians called it a unique situation, but it wasn't. It was a blueprint. After Cyprus, bail-in laws spread across the Western world like wildfire. Canada adopted them in 2013. The European Union followed with the BRRD directive in 2014. In 2018, the United States updated its Dodd-Frank Act, ensuring that no taxpayer money would be used for future rescues without mentioning that your deposits would now be at risk. And here's the part that almost nobody knows. Every major Western bank, JP Morgan, Deutsche Bank, BNP Paribas, Barclays, is legally structured to execute a bail-in within 48 hours of insolvency. It doesn't require your consent. It doesn't need a vote. It's automatic. This is why, since 2015, every new banking term you sign, every terms and conditions box you tick online, contains a clause granting the bank the right to use client funds as part of a resolution process. They've told you. They've written it. You just didn't read it. And when the next banking crisis hits, which many analysts believe is already unfolding quietly behind the scenes, it won't be Wall Street or the Fed that pays the price. It will be ordinary people again. Because the real scam is not the collapse itself, it's the illusion of safety before it happens. To understand how this silent heist was built, you have to look at who really controls the financial system. Not your local government, not even your president, but a network of unelected technocrats, the central bankers, regulators, and economists who write the rules for the entire global economy. At the top of this pyramid sits an institution few people even know exists, the Bank for International Settlements, or BIS. Headquartered in Basel, Switzerland, it's often called the central bank of central banks. Its meetings are closed. Its decisions are unrecorded. And yet, every major financial reform of the past 50 years has come from within its walls. In 2009, right after the global financial crisis, the BIS formed what they called the Financial Stability Board, a kind of shadow government for world finance. Its mission: to ensure that no future crisis would threaten the system again. Its real function: to make sure the system could save itself no matter the cost to ordinary citizens. By 2011, the board released a document with an innocuous name: Key Attributes of Effective Resolution Regimes. Buried inside was the plan that would change the world, the bail-in mechanism. The language was sterile, bureaucratic, impossible for most people to understand. It talked about resolution frameworks, recapitalization instruments, and loss-absorbing liabilities. But what it really meant was simple. If a bank goes down, the losses will be absorbed by the depositors. This was not a theory. It was a system meticulously designed and coordinated across continents. Every major economy, from the EU to the US, from Canada to Japan, adopted identical versions of the bail-in law between 2011 and 2018. In each country, the language was the same. The public never voted for it. Parliaments rarely debated it. It just became law. When questioned, officials justified it as necessary for financial stability. But what kind of stability requires stealing from citizens to save the guilty? The kind of stability that protects the system, not the people. Because make no mistake, the banks are no longer intermediaries. They're infrastructure. They are extensions of government power wrapped in private logos. And when that power feels threatened, it protects itself by all means necessary. Think about this. In 2023 alone, American banks lost over $620 billion in unrealized bond losses. European banks faced record liquidity gaps. In normal times, this would be a crisis. But now, they don't panic, because they know exactly how the next collapse will be handled. Not by the Fed, not by taxpayers, but by you, the depositor. And if you think your insurance will save you, think again. Deposit insurance programs like the FDIC in the US or the European Deposit Guarantee Scheme only protect a tiny fraction of total deposits. They are confidence tools, not safety nets. When the system fails, the funds simply aren't there. Even worse, the fine print of these protections explicitly allows authorities to suspend withdrawals during a financial emergency. In other words, the very moment you need your money most, you may not be able to access it. This architecture of control is not a coincidence. It's a survival mechanism. Every piece of regulation since 2008, from Basel III to Dodd-Frank, has one goal: to ensure that banks can fail without collapsing the system. But the way they achieve that is by collapsing you first. The irony is brutal. They call it financial stability, but what they really mean is systemic immunity. The system survives, even if you don't. And behind this illusion of safety, a new frontier is already being prepared: the digital financial grid. Central bank digital currencies, CBDCs, are the next evolution of control. Once physical cash disappears and money becomes programmable, a bail-in won't even require legislation. It will be an algorithmic adjustment, instant, silent, irreversible. Imagine waking up to a message on your banking app. Due to a temporary liquidity event, 12% of your balance has been converted into digital bank equity. It sounds dystopian, but that's exactly how every empire rationalizes control: one law, one crisis, one convenience at a time. In 2013, it happened in Cyprus. In 2023, several regional banks in the US quietly tested emergency resolution procedures. And in 2025, new CBDC pilot programs now integrate automatic stability mechanisms for deposit conversion. The blueprint is complete, and the next phase is already being coded. The final phase of the system is already in motion. You can feel it in the price of food, in the shrinking value of your paycheck, in the quiet unease that no one can quite explain. This isn't just another financial cycle. It's the slow execution of a monetary reset that nobody voted for, but everyone will live through. Every empire reaches this point. Rome did when it clipped its coins. Britain did when it abandoned gold. And now the United States, the center of the dollar system, faces the same fate. Only this time, the collapse won't be fought with swords or cannons. It will be digital, invisible, and legal. Here's how it unfolds. Step 1. Create a crisis. It could be a major bank failure, a sovereign default, or a cyber attack on the financial grid. Step 2. Freeze withdrawals temporarily. Step 3. Convert a portion of private deposits into bank equity. Step 4. Introduce a central bank. Digital currency as the safe and modern replacement. And just like that, ownership, privacy, and autonomy vanish in a cloud of code. The groundwork is already laid. The Federal Reserve's FedNow system, launched in 2023, enables real-time clearing between banks, the same infrastructure needed for a digital dollar. The European Central Bank's Digital Euro project goes live in 2026. China's digital yuan is already used by millions. Every major economy is converging toward the same model: programmable money with centralized control. Once that switch flips, the concept of bail-in becomes obsolete, not because it disappears, but because it becomes automated. No need for politicians or bankers to seize your funds. The system itself will simply reassign them. Your balance will adjust for stability. Your access can be paused for security. And the most terrifying part? It will all look normal. They'll tell you it's for your safety, to protect against fraud, crime, terrorism. But digital control over money means digital control over life. Where you can spend, what you can buy, what you can donate, all programmable, all traceable, all reversible. The bail-in becomes not a reaction to crisis, but a built-in feature of the new financial operating system. We've seen this before. In 1933, during the Great Depression, President Roosevelt confiscated private gold for national recovery. In 1971, Nixon severed gold from the dollar to protect stability. Now, in 2025, the same justification is being prepared for digital currency. They'll call it modernization. They'll call it efficiency. But history calls it control. This isn't conspiracy. It's legislation. Every G20 nation has passed or is drafting bail-in and digital currency laws. Every central bank is testing programmable liquidity measures. And every crisis, from inflation to war to cyber attacks, is used to tighten that net. But here's the truth they don't want you to hear. You are not powerless. History shows that individuals who understand the system before it breaks are the ones who survive it. When Rome fell, the people who owned land and gold endured. When Britain lost its empire, those who diversified into foreign assets survived. And when the Soviet Union collapsed, those who built networks and self-reliance thrived. Today, the smart money is already moving. Central banks are buying record amounts of gold, not because they love tradition, but because they know what's coming. Billionaires are investing in farmland, private vaults, and decentralized assets. They are exiting the system quietly while the public is distracted by headlines and hashtags. The question isn't whether the bail-in will happen again. It's when. And when it does, it won't look like theft. It will look like policy, a smooth transition, a necessary measure. But by then, the damage will already be done. The reset won't come with an explosion. It will come with a notification. A single line on your banking app that says, "Due to market instability, your account has been temporarily adjusted." That's it. No sound, no panic, no rescue. Just silence. The sound of ownership dissolving into the system that was always designed to take it back. The only defense is awareness, preparation, and independence. Physical assets, real skills, local communities. Things that can't be deleted, frozen, or converted. Because the moment you let your wealth exist only as data, it's not your wealth anymore.